Ever get that feeling when you're trying to understand something important like how the rules work for someone managing your investments?
Hmm.
And suddenly it just feels like you're swimming in this sea of regulations.
Yeah, it can be overwhelming.
You just want the key points, right? Without needing like a law degree.
Exactly.
Well, that's exactly what we're diving into today.
Yeah.
We're going to unpack the core regulations for investment advisors right here in India and, make sense of what you really need to know.
That's the plan. We've got some pretty comprehensive material here, excerpts from a chapter that outlines all these regulations, and our job really is to pull out the crucial principles, the stuff that actually matters.
Right. Whether you're just curious or maybe you really need to have a solid grasp of the landscape.
Precisely.
Okay, so where do we even begin with this? Let's start with something foundational. The Securities Contracts Regulation Act, or SCRA, way back from 1956.
Yeah, that's an old one.
It is, but its purpose is actually pretty fundamental, isn't it?
Absolutely. Think of it as the kind of the initial step
Okay.
to prevent undesirable activities in buying and selling securities.
Right, setting ground rules.
Exactly. Ground rules for the business of dealing in them, controlling stock exchanges, the agreements you make when you trade.
Because buying a security is basically a contract. Yeah.
It is a contract.
Yeah.
And this law specifically applies to that. It also covers how companies get their shares listed.
So this act, even though it's from the 50s, it sort of laid the groundwork.
It really did. It reflects that early understanding of what could go wrong and the government's first real move to bring some order. It's like the blueprint, for later, more detailed regulations like the SEBI Act.
Okay, building on that foundation then, we get the SEBI Act of 1992. Now, SEBI Securities and Exchange Board of India, this act has a really clear mission.
Very clear. Protect investor interests, promote the market, and regulate it.
And it gives SEBI some pretty significant authority.
Oh, definitely. Yeah. The SEBI Act is what gives the regulator its teeth, its power. It's not just good intentions.
It's a toolbox.
The whole toolbox, yes. For instance, SEBI is in charge of regulating the stock exchanges themselves, the marketplaces where all the trading happens.
Exactly. And their job doesn't stop there, right? SEBI also handles the registration and regulation of all sorts of intermediaries.
Oh, they're lawyers, yeah.
Stockbrokers, share transfer agents, and crucially for us today, investment advisors.
That's a key one.
So generally, if you want to be an investment advisor, you need SEBI's okay.
You do. And the list SEBI oversees is pretty long. Depositories.
Where securities are held electronically.
Right. Custodians who look after assets, foreign portfolio investors, even credit rating agencies. It's a wide scope.
It really is. Plus, SEBI is the authority for registering and regulating things like venture capital funds.
And collective investment schemes.
Which most people probably know as mutual funds.
Exactly. So a huge chunk of the investment world.
And when things go wrong or look a bit, dodgy.
SEBI steps in. They prohibit fraudulent and unfair trade practices. They crack down on insider trading, trading on non-public info.
Right. And they also regulate big share acquisitions and company takeovers.
As they do. And to make sure everyone's playing by the rules, SEBI can ask for information, conduct inspections, launch inquiries, even audits.
Audits of exchanges, mutual funds, all those players.
All of them. They can also charge fees, helps fund their work, and they do research, too, to understand the market better.
And importantly, going back to accountability, penalties, right?
Yes, the SEBI Act lets them impose penalties if intermediaries don't give the info needed or don't have proper client agreements.
They can get fined.
They can. It's all about ensuring a basic level of, proper behavior and transparency.
Okay, so we've got the big picture. SARA, SEBI Act. Now let's zoom in a bit. Specific regulations affecting investment advisors directly. First up, the SEBI Prevention of Fraudulent and Unfair Trade Practices Regulations 2003.
The name says it all, really. Stop dishonest dealings.
And what's key here is how SEBI defines fraud, right? It's quite broad.
It is broad. It's not just about making an unfair profit or causing a loss. It includes any act, expression, omission, or concealment if the intent is to induce someone to deal in securities.
That intent is the crucial part.
Yes. Even if there's no actual wrongful gain or loss in the end.
Okay. And the regulations give some specific examples.
They do. Like willfully misrepresenting something or concealing a material fact. You can't just leave out important stuff.
So being dishonest, basically.
Exactly. Or suggesting something is true when you actually don't believe it. Active concealment of a known fact is another one.
And this one's interesting, making promises without intending to keep them.
That's fraud too under these rules. You can't just say whatever it takes to get someone's money.
Wow. Okay. Anything else?
Yeah, even making reckless or careless representations. Whether they turn out true or false, if you haven't done your homework, that can be fraud too.
So due diligence is key.
Very much so.
All right, moving on. The SEBI intermediaries regulations from 2008. These cover lots of market players, but there are bits focused on investor protection, especially the code of conduct.
Absolutely. The main idea here is that intermediaries, including investment advisors, have to really try to protect client interests, give the best possible advice based on the client's needs and the advisor's own skills.
It's about high standards, integrity, dignity, fairness, ethics, professionalism.
All of that for the intermediaries and their personnel. And importantly, the intermediary is responsible for what their employees or agents do.
So the buck stops with the firm.
That's right. They can't pass it off. Responsibility to ensure everyone under their banner follows the rules.
And they need to exercise due diligence, skill, independent judgment.
Independent professional judgment, yes. And avoid any collusion that could harm investors.
What about fees? Can they just hike them up?
No, they need to give proper advance notice before increasing fees. No surprises for the client.
Okay. And getting money back to clients, like dividends.
That needs to be done promptly. No unnecessary delays in dispersing dividends, interest, or other accruals.
And information disclosure, how does that work?
Intermediaries need to provide adequate, comprehensible, and timely information so clients can make informed decisions.
No jargon overload or hiding things.
Exactly. No misrepresentations, no misleading information, and no exaggerated statements about their own qualifications, capabilities, or past achievements. Keep it factual.
Got it. And client confidentiality.
Super important. Intermediaries cannot divulge confidential client info without prior permission, unless, of course, they're legally required to. But the default is confidentiality.
Okay, next up. SEBI, Prohibition of Insider Trading Regulations, 2015. This is all about preventing trading based on non-public price-sensitive information, right, Tiff?
Precisely. Making sure the playing field is level.
And who's an insider?
It's defined quite broadly. A connected person or someone who simply has access to unpublished price-sensitive information, UPSI.
Like knowing about earnings before they're announced.
It's exactly. Or a big merger deal. Trading on that gives an unfair advantage. It really affects market integrity. People lose trust.
So these regulations define insiders, what they can't do.
Yes, prohibited actions, and they also require listed companies and intermediaries to have internal systems and fair conduct policies to prevent it.
Okay, now we're getting to the core. The SEBI Investment Advisors Regulations, 2013. This is the specific rule book for investment advisors.
That's right. Put in place to regulate the whole range of entities providing investment advisory services.
Banks, financial planners, distributors giving advice.
All of them bring structure and oversight.
Okay, and like any good rule book, it starts with definitions. Let's tackle some key ones. First, assets under advice. What does that cover?
Basically, it's the total value of securities, stocks, bonds, etc., for which the advisor has given advice. Doesn't matter if they handled the trade, just if they advised on it. It's the aggregate net asset value.
And why is that definition important?
It can impact things like fees, registration categories, maybe even capital requirements down the line as the business grows.
Got it. Next, family of client and family of an individual investment advisor.
These list the immediate relatives, spouse, dependent children, dependent parents usually. Important for conflict of interest rules.
Okay, financial planning. We hear that a lot.
In this context, it's a formal process, analyzing the client's current situation, income, assets, goals, then identifying those goals, retirement, house deposit, whatever, and finally, developing strategies to reach them. It's holistic.
More than just stock tips then.
Much more.
And investment advice itself, how broad is that?
Pretty broad. Advice on dealing in securities, investment products, constructing portfolios, include financial planning. Can be written, oral, any medium, really.
But there are exceptions, like general news articles?
Yes, if it's general commentary on market trends in, say, a newspaper or on TV without specific security recommendations, that's usually not investment advice under these rules.
What about those really short-term trading tips, trading calls?
Ah, good point. Those intraday, ultra-short duration, non-personalized recommendations. They generally fall under the SEBI research analysts regulations, not the IA regs.
Okay, separate rules for those. So who is an investment advisor then?
Anyone engaged in the business of providing investment advice for consideration, meaning for a fee or other compensation, full-time or part-time. If you're doing it as a business, giving advice on securities portfolios for payment, you likely fit the definition.
even if you don't call yourself an advisor.
Potentially, yes. It's about the activity.
The non-individual, that's just firms, right?
Correct. Body corporate, like a company, limited liability partnerships, LLPs, partnership firms, anything not a single person.
Other business activity or employment, why define that?
This refers to work that's not related to securities advice and doesn't involve handling client funds or giving recommendations. It's important for part-timers to distinguish their advisory role from other jobs and manage potential conflicts.
Which leads to part-time investment advisor. Simple enough. Someone giving investment advice for a fee, but also doing other work.
Persons associated with investment advice. Sounds like the whole team.
Pretty much. Members, partners, directors, officers, employees, even sales staff involved in the advisory service.
And the principal officer.
That's the key person responsible for the advisory business within a non-individual firm. The point person for compliance.
Okay, we covered trading calls, so definitions sorted. What's next? Registration.
Absolutely crucial. Registration. You cannot act as, or even hold yourself out as, an investment advisor without a valid certificate from SEBI.
It's a license to operate.
Exactly.
And what does SEBI look at when someone applies?
A whole range of things, individual or firm. Qualifications and certifications of the applicant and associated persons. Deposit requirements met. And critically, are they fit and proper persons? That's based on Schedule 2 of the intermediaries regulations.
Fit and proper. What does that really check? Integrity. Competence. Both. Past conduct, regulatory actions, convictions for certain offenses, financial soundness sometimes. Basically, can they be trusted?
Makes sense. What else? Infrastructure.
Yes. Do they have the necessary setup, office, tech, systems? Have they been refused registration before? Any past disciplinary actions?
What about banks or NBFCs wanting to advise?
They usually need RBI permission first, and SEBI generally requires them to offer advice through a separate department, division, or even a subsidiary.
You keep it separate from lending and other activity.
Exactly. Manage conflicts of interest. Similar separation rules apply to other non-bank entities too.
And foreign firms or citizens wanting to advise in India.
Typically, a foreign entity needs an Indian subsidiary or branch.
Right.
A foreign citizen usually needs a presence in India to get registered for oversight.
Now, registration is the rule, but are there exemptions?
Yes, some specific categories are exempt, usually where advice is incidental or they're already regulated elsewhere for that specific advice.
Like general market commentary.
Right. Good faith comments on trends, not specific securities. That's exempt. Also, registered insurance agents advising only on insurance products.
Because they're regulated by IRDA?
Correct. Same for registered pension advisors, advising only on pension products. They're under PFRDA.
What about mutual fund distributors?
If they're members of an SRO or registered with AMFI, they can give incidental advice related to mutual funds as part of their distribution work. But the advice must be incidental.
And professionals like lawyers or accountants.
Advocates, law firms, members of professional bodies like ICI, if the advice is purely incidental to their main professional practice, they're generally exempt.
Fund managers.
Fund managers of registered entities like mutual funds or AIFs don't need separate IA registration for managing the fund itself.
Any other notable ones?
Those advising only clients outside India are exempt, but that doesn't cover NRIs or PIOs. Also, principal officers, associated persons, partners of registered IAs don't need individual registration if they meet the qualification certification requirements. And SEBI can always specify others. But even if exempt, they generally still need to follow the basic obligations in Chapter 3 of the IA regs.
Okay. For those needing registration, what about qualifications and certifications? Can't just be anyone.
Definitely not. Specific requirements. For individuals or the principal officer of a firm, a professional qualification, or a relevant postgrad degree diploma of at least 2 years.
Relevant fields like finance, economics, business.
Yes. Or, alternatively, a postgraduate program in securities market, investment advisory, from NISM at least 1 year long, or a CFA charter.
Okay, and the rest of the team, the persons associated.
Minimum is a graduate degree in any discipline, so a baseline education for everyone giving advice.
And it's not just degrees. There are mandatory certifications, too, from NISM.
Correct. Relevant NISM certifications are mandatory for individual advisors, principal officers, associated persons, partners involved in advice. And crucially, these aren't one-offs. They need continuous renewal. Keep knowledge current.
So once you get the certificate, are there ongoing conditions?
Oh, yes. It's not just a one-time thing. You have to adhere to the SEBI Act, The IA regulations, SEBI circulars, that's fundamental.
What else? Reporting changes.
Immediately. If any info given during registration becomes false or misleading, or if there are material changes, address, personnel, structure, tell SEBI right away.
And the name. Does the firm have to call itself an investment advisor?
Generally, yes, for non-individuals, companies, LLPs. They need investment advisor in their name, helps clients identify them. Same for separate divisions or subsidiaries.
And individuals.
They must use investment advisor in all correspondence. If they're part-time, they must use part-time investment advisor. Clarity for clients.
What if an individual advisor's business grows really big?
There are thresholds. Exceeding 300 clients or INR 3 crore in fees in a financial year, whichever's first.
Then they need to become a non-individual.
Generally, yes. They need to apply for non-individual registration. Recognizes the need for potentially more robust structure and oversight.
Is there a limit for part-timers?
Yes, currently 75 clients. Exceed that, and they might need to look at full-time registration.
We mentioned a deposit requirement earlier. Can you explain that again?
Sure. Advisors need to keep a deposit with a scheduled bank. It's marked with a lien in favor of a SEBI-recognized body that handles administration and supervision.
Like a security deposit, what's it for?
It's a safeguard. If the advisor owes money to a client due to an arbitration award or conciliation through SEBI's dispute resolution mechanism, this deposit can potentially be used to pay those dues.
Okay, now the general obligations, the day-to-day principles. Acting as a fiduciary seems key.
Absolutely paramount. They must act in a fiduciary capacity. Put the client's best interests first, always.
Above their own interests.
Above everything else. And disclose all conflicts of interest. Upfront, fully.
And how they get paid. Restrictions there.
Big one. They cannot receive any consideration, commission, referral fee, anything from anyone other than the client for the products they advise on.
To avoid bias.
Exactly. Advice should be based purely on the client's needs, not on what pays the advisor more from a third party.
What if they have other businesses?
Need to maintain an arm's-length relationship between advisory and other activities. Keep them separate, avoid influence.
Oh. Separate departments? Disclosure.
Both. Often requires clear segregation, like a separate division, and full disclosure of any potential conflicts arising from those other activities.
Client confidentiality, we touched on it, but it's worth repeating.
Absolutely. Strict duty. Cannot share sensitive client info without explicit prior permission, unless legally mandated.
What about advisors trading for themselves?
Restrictions apply. Generally, can't trade personally in a security, contrary to advice given to a client on that same security for 15 days after giving the advice. Exception if the situation changes, but they must tell the client 24 hours before their own trade. Prevents front-running.
Other key obligations, KYC, Code of Conduct.
Yes, follow KYC procedures. Abide by the Code of Conduct, we'll get into that more. Prohibited from knowingly buying from or selling to clients for their own account.
What about changes in ownership of the advisory firm?
Need prior SEBI approval for any change in control. SEBI needs to vet the new owners.
And reporting to SEBI, staying qualified. AI.
Ongoing obligation to furnish info to SEBI. Continuous compliance with qualification certifications. And if using AI, they're responsible for the data security and the advice generated.
Okay, let's talk fees. How do advisors charge?
They can charge fees, yes, but SEBI has guidelines. Fees must be agreed upon with the client, structured transparently. Limits exist based on service type and assets under advice. Fair and clear is the principle.
Understanding client risk tolerance seems absolutely vital. How's that handled? Risk profiling.
Cornerstone, yes. Risk profiling. Advice and asset allocation must be appropriate for the client's ability and willingness to take risk.
What info do they need to gather?
Age, objectives, time horizon, income, assets, liabilities, risk appetite. They need to get this info and update it periodically.
And how do they assess the risk from that info?
It's about judging capacity for loss, unwillingness to accept capital loss, interpreting responses carefully, not just ticking boxes. They can use tools, surveys, questionnaires, but must ensure they're fit for purpose and understand their limits. Questions must be fair and clear.
Then communicate the profile to the client and keep it updated.
Exactly.
So once you have the risk profile, the advice needs to be suitable. What does that entail?
Suitability links directly to risk profile. The advice must be appropriate for that client. No pushing high-risk stuff on conservative clients.
Do they need a process for this?
Yes. A documented process for selecting investments based on client objectives and financial situation. And the advisor must understand the products they recommend. Nature, risks.
They can't just recommend something they heard about.
No. Must have a reasonable basis to believe the recommendation meets objectives, is within risk tolerance, and the client understands the risks.
What about complex products?
Even stricter suitability checks there. You need a reasonable assessment that the product's structure and risk-reward profile fit the client's experience, knowledge, objectives, risk appetite, and loss capacity.
Transparency again. What specific disclosures are required?
Lots. Material info about the advisor business, disciplinary history, terms, affiliations, disclosure of the advisor's own holdings in recommended products, disclosure of actual or potential conflicts from connections to issuers.
What about the products themselves?
Adequate disclosure of material facts, key features, risks, performance track record. Draw attention to warnings and disclaimers.
What if the product isn't regulated by SEBI?
Must disclose that. Tell the client SEBI recourse isn't available for that specific product. And disclose the extent of AI tool usage and advice.
Keeping track of all this requires good record keeping, I imagine.
Essential. Minimum retention period of 5 years. Physical or electronic.
What record specifically?
KYC docs, risk profile, suitability assessment, client agreements, the advice given, the rationale behind it, client to register, communication records, electronic records needing signatures must be digitally signed.
Is there an audit requirement?
Yes. Mandatory yearly audit of regulatory compliance by a member of IKI, ICSI, or ICMI. Report submitted to SEBI. Plus, maintain a functional website with required details.
Do larger firms need a dedicated compliance person?
Non-individuals must appoint a compliance officer. Can be an employee or an independent professional with a relevant NISM certification. They oversee compliance.
If it's an independent pro, is the firm still responsible?
Yes, the principal officer remains ultimately responsible and usually gives an undertaking to that effect.
What if a client has a complaint? How are grievances handled?
Advisors need adequate procedures for prompt redressal within SEBI timelines. Note: complaints about the product itself go to that product's regulator. Formal disputes can go through mediation, conciliation, arbitration via SEBI's mechanism or an ombudsman.
We talked about potential conflicts. How are advisory and distribution activities kept separate?
Strict rules. Individual advisors cannot provide distribution services at all. Full stop.
What about their family?
Family of an individual advisor can't provide distribution to the advisor's clients, and vice versa. Keeps it clean.
And for larger firms, non-individuals.
Must have client-level segregation at the group level. Same client generally can't get both advisory and distribution from the same group.
How's group defined?
Usually based on the Companies Act definition, common control, controlling interest.
How do they maintain this separation internally?
Arm's length relationship. Often advisories in a separate department division. Clear policies and monitoring needed per SEBI guidelines.
What about actually implementing the advice? Buying the stocks?
Advisors can provide implementation services, but crucially cannot receive any consideration, direct or indirect, at the group family level for it. Services must be through direct schemes products. Clients are not obligated to use the advisor for implementation. No implementation fees allowed.
The regulations also have a code of conduct, key principles.
Yes, third schedule. Honesty, fairness, diligence, acting in client's best interest, maintaining market integrity, need capabilities, resources, gather client info, keep it confidential.
What else? Fees, conflicts, compliance.
Provide adequate info to clients. Fair and reasonable charges. Avoid conflicts of interest. If unavoidable, disclose fully and treat client fairly. Compliance is mandatory. Senior management is responsible for ensuring the code is followed. SEBI's also tightened things via circulars, restricting free trials, emphasizing proper risk profiling and consent, fees only via banking channels, displaying complaint status on website.
What happens if they break these rules?
Yeah.
Default procedures.
Contravening the act, regs, circulars, failing to furnish info, giving false info, not submitting reports, not cooperating, not resolving complaints, all can lead to action under the SEBI Intermediaries Regulations, 2008.
And penalties.
Can be substantial. Under Section 15EB of the SEBI Act, minimum penalty of INR 1 lakh, potentially up to INR 1 lakh per day of default, maxing out at INR 1 crore. Serious consequences.
How is SEBI managing the administration and supervision of all these advisors?
They've decided to recognize subsidiaries of stock exchanges to help with this. Specific criteria apply for recognition.
Like?
Years of existence, net worth, nationwide terminals, grievance redressal mechanism, investor service center reach.
And who's been recognized?
BSE Administration and Supervision Limited, BASL, a subsidiary of BSE.
What do they do?
Supervision, on-site, off-site, grievance redressal, administrative actions, warnings, referrals to SEBI, monitoring, maintaining a database, reporting to SEBI.
What about the IFSC, the International Financial Services Center? Special rules.
SEBI has IFSC guidelines from 2015. The regular IA regs generally apply there too, but IFSC advisors can usually only serve specific client types defined in those guidelines, and non-resident clients must comply with their home country regs too.
Okay, let's shift gears slightly. Prevention of Money Laundering Act, PMLA 2002. How does this affect advisors?
PMLA targets disguising illegal money, makes it an offense to be involved with proceeds of crime concealing, possessing, using, claiming it as clean. It's a continuing activity.
What obligations do advisors have as reporting entities?
Under Section 12, maintain transaction records, 5 years post-transaction. Furnish info on prescribed transactions. Maintain client ID docs and correspondence, 5 years post-relationship account closure. Maintain confidentiality.
And enhanced due diligence, Section 12 delay.
Yes, for certain higher-risk situations. Verify client identity more thoroughly. For example, Anhar. Examine ownership, financial position, source of funds, record purpose of specific transactions. Maintain info for 5 years.
What triggers this?
Specify transactions like large cash movements, high-value forex, remittances, other high-risk deals. Increase monitoring of suspicious transactions is also key.
Does SEBI have its own AML guidelines too?
Yes. Comprehensive AML-CFT guidelines applicable to all SEBI-registered intermediaries, including foreign branch subsidiaries, within legal limits. Detailed procedures to comply with PMLA.
And the KYC registration agencies, KRAs.
They help streamline KYC, the process of identifying and verifying clients. KRAs collect and maintain KYC docs as per SEBI's AML guidelines. All investors need to be KYC compliant personal details. ID address proof. Non-individuals need constitutional docs too.
Okay, the source material also briefly lists other relevant acts. Can we touch on those quickly? FEMA.
Sure. Foreign Exchange Management Act, 1999. Regulates forex, external trade, payments. Applies also to overseas branches of Indian entities and violations abroad. Sets RBI go powers. Section 6 covers capital account transactions. Rules for residents investing abroad. Non-residents investing in India, FPI versus FDI. Important for NRI clients or foreign investments.
Indian Contract Act.
The Foundation, 1872 Act. Governs all contracts, including advisor-client agreements. Defines contract essentials. Offer acceptance, legal intent, free consent, lawful object, capable parties. Advisory agreements must comply.
Guardian and Wards Act, for minors.
1890 Act protects minors under 18 and their property. Defines guardian. Ward, court can appoint guardians. Important of advising regarding minors' investment.
Negotiable Instruments Act.
1881 Act, laws for promissory notes, bills of exchange, checks. Defines them, covers capacity, liabilities, negotiation, payment, dishonor, crossing checks, penalties. Relevant for payment methods.
Insolvency and Bankruptcy Code, IBC.
2016 Code. Consolidates insolvency bankruptcy laws for corporates, partnerships, individuals. Time-bound resolution defines bankrupt. Important background legal landscape.
And FACAC-SAXAR's international tax stuff.
Yes. FSCN is U.S. law. Prevents tax evasion by U.S. persons via foreign accounts. Requires reporting by foreign financial institutions like Indian advisors banks to CBDT, then to U.S. IRS. Investors may need self-declarations. CRS is the global version. OECD standard for automatic exchange of financial account info between countries to fight tax evasion. Reporting financial institutions, RFIs, identify and report on accounts held by foreign tax residents. Definition of financial institution is broad. Custodial, depository, investment entity, insurance co. NBFCs can fall under this. Need to check Income Tax Act guidance notes for specifics.
Okay, to really see the impact, let's look at the case studies provided. Violations by registered advisors. Case 1. Unregistered advisors.
Right. SEBI got a complaint about an entity giving trading tips, soliciting clients, but without registration. Investigation showed they were providing advisory services for fees, meeting the definition, but lacked the mandatory SEBI registration.
Key takeaway.
Registration is non-negotiable. It protects investors, ensures oversight. Without it, investors lose standard grievance redressal routes.
Case 2. False credentials.
This entity used free trials to lure clients, then pushed hard for paid services with tips and stock recommendations. Complaint mentioned promises of huge returns for big fees.
What was the main finding?
The experience certificate submitted by the proprietor during registration was forged. Fake documents.
Big violation.
Huge. Violated certificate conditions and regulations. SEBI restrained them from the market, canceled their registration. Also shows promising exorbitant returns is viewed very dimly. Intermediaries must protect investors, not make wild promises.
So wrapping up this deep dive, it's really clear these regulations are complex, but absolutely vital.
Definitely. Vital for a fair, transparent investment environment.
The key themes really seem to be that constant focus on protecting you, the investor.
Absolutely. Investor protection first.
The necessity of registration, ethical conduct.
And serious consequences for noncompliance.
Right. So here's a final thought for you, our listeners. Considering all these layers of regulation we've discussed, what do you think is the biggest ongoing challenge in balancing a thriving, innovative investment market with strong, effective investor safeguards?
That's a great question to ponder.
Indeed. And if you want to explore this even further, definitely check out the SEBI website. Look into the specific acts and regulations we've talked about today.
There's always more detail available if you're interested.